way you would approach this?
Absolutely. Absolutely. And you can do this for funds also. You need the information from the fund house, and you will find that on an equity market mutual funds have actually protected capital over 5 years itself.
Interesting.
Which itself tells you that they do better than the index in that, right? So this could also be a way of evaluating funds to see at what point do they protect capital. So, and that's why I said, the point is that it's important though to understand your own risk-taking capacity, right? So in a way, the maximum, minimum and average can be equated to a pessimistic, optimistic individual, pessimistic individual, and somebody who's more realistic, saying, on an average I'll get this, but there could be either way. So the key element here, 2 points I want to drive with that.
Please.
Past performance to predict future is what is used by everybody. Do I come and tell them don't use it? There's nothing else to use, so what else do they use? So if you want to use past performance, which is the only realistic, use the rolling returns past performance, right, which will give you a reasonable estimate of the future and will help you to prepare yourself for the worst case scenarios, the best case scenarios, right? So why it's important, the best case scenarios, most like I said, you do a goal-based investment. And the key is that when your goal is reached, you get out. Right? You may choose a 7-year investment, but your goal was to triple your money or whatever. If you reach it in 5 years, this tells you that take it out.
Sure.
Right? So I think the beauty of this analysis is that it manages expectations, it's a more reliable predictor of the future, and it's basically a probabilistic tool.
How do I, as a retail investor, get this data?
Okay, so there are two choices, of course. One is, I think most advisors have access to, value research, money control, NAV India, where this daily, you need daily data points of the market, you need daily data points of the fund, right? So most of your advisors should have this. It requires a little bit of hard work. It requires an Excel spreadsheet to do this, right? So those who are mathematically all it needs is that you go and pick up daily points of the Sensex, right? If you were doing it for the Sensex, put it in an Excel sheet. It's almost like a daily SIP, right? So suppose you're doing a 1-year thing, it's like every day you make a 1-year investment. So it's like a daily SIP. You just put into Excel, and Excel has enough features, right? So of course, a little bit of knowledge of Excel would be required, otherwise that. So it should not be a problem. But otherwise, I would say an advisor would give you the capacity to do this for multiple funds and show you the fund manager who has protected your capital in the least amount of time, who has, when the going is good, maximize your return the most, right? So all kinds of, you can play around with the numbers from an advisor's perspective. So I would say that, to me, the investor to the advisor should challenge the advisor to say, please show me the rolling returns, whatever you're recommending, show me the rolling returns performance of it. And then, why are you choosing X fund over Y fund? Is the rolling returns performance of this one better than that one? And then when you go with the choice, you have the data, please take a printout of that and keep it with you. So at the end of 3 years, you see whether that helped you or not. Because I think preparedness for the outcome, right, is half the battle.
True. Yeah, that's well put. The final question that I would have on this subject is, to have these parameters worked very well across fund sizes and across time frames? I mean, have you had a chance to analyze some of your funds, irrespective of the size, with the rolling return criteria, and have they given an almost near accurate returns if you indeed use the rolling return criteria in the past as well, and not just right now?
In fact, I'll go one step further. So I will tell you that even a high risk funds, right, like a mid cap and a small cap fund, over 5 years have always protected capital.
Okay.
One. And what it has done, this study has helped us, is that we make most of our investments with a 5-year outlook on the stock. So it's actually fed into fund management, and fund management is fed into the result. Because when you buy a stock with a 5-year outlook, intermediate points of volatility in the stock's EPS, price, everything actually make you keep a level head and look at that long-term goal because of your assessment. And what this shows is that the fund manager's assessment of the 5-year performance has by and large turned out correct. Otherwise, you could have never protected the capital. So I think this has a very close link. This is something we use all the time in terms of assessing. And one additional point on this, right? Now I'm saying this, there are lots of people who are on this, listening to this show, who have already invested in the market. Now let's say over the last 1 year I showed you mid-caps have shown a negative return. Now you invested in a mid-cap fund, or let's say out in the 1 year back. Now you're sitting on a negative return. So you'll be worried. What do I do? This rolling return slide, like for example, if you take, I told you, 5 years is a fund has protected capital. What this gives you a comfort, independent of that past 1 year's negative return, you waited for 4 more years, you're assured of not losing your capital. So even for existing investors, it's not that only to make a fresh investment you need to do a rolling return. I would encourage investors already to their portfolio, to that fund, to do a rolling return. Then if you're facing a situation, and the other way too, right? If your returns are very high and you look at the average returns and you say it's going to revert to that mean, you can also decide how long do I stay invested. So I think it's a very powerful tool. I've just given a glimpse of the thing, but I think if this were used more often by investors and by advisors, it would make the whole disappointment with equity performance, people saying, "Are 1 year SIP return negative," it would make them say, this is the time frame I wait, and second, they know that in 1 year this was the probability of a negative return, and they are prepared for that outcome. So I think the overall milieu of stock market investing from an investor, advisor and the manufacturer perspective would be much healthier if this could be an industry-wide practice and adopted by a larger proportion of its constituents.
Well, let's wait and watch. I just hope that via this conversation, what we've probably tried to bring to you is one more arrow in your arsenal to try and analyze your investments in a better fashion. But as Mr. Subramaniam said, do ask or do consult with your financial advisor and see if you can get it. If you are indeed an Excel genius or a mathematical genius then and want to invest in funds, then maybe you can try and attempt some of this yourself as well. Might help you better in choosing the funds and then staying about it. In fact, even might help you in trying and identifying how soon do you get out of these investments too. Mr. Subramaniam, so good having you. Thank you so much for taking the time out and being with us and explaining a rather difficult concept in a much simpler fashion. Right. Really appreciate your time.
Thank you.
Thank you so much.
Wish all the viewers all the best.
Thank you so much, Mr. Subramaniam. Happy festivities.
Same to you and to the viewers.
Yes. Okay. So that's the view from Mr. SunilSubramaniam of Sundaram Mutual Fund, who just spoke to us about the rolling return concept. Well, one way to try and identify how best to analyze your mutual fund investments. As we said, maybe get out or stay into these investments as well. What we'll try and do now is, as we promised, try and get in an advisor who can advise about some individual schemes as well, some ways and methods of trying to analyze the current investments that you have. A bunch of queries have come into us on